Hello and welcome back to another episode of Fun Friday with a very special guest, my friend and partner here, the principal and founder of Levy Capital, Jonathan Levy. How are you today?
Hi, I'm good, Craig. It's nice to be with you. Appreciate finally getting to do this.
Yeah, absolutely. Well, you are in a different position and role than anyone else that has been on the show. And I think you provide a very unique lens and insight to the business because you work on both ends of the spectrum. So, what Jonathan is an equity broker. So, for those who don't know what an equity broker is, it basically means that he's kind of a middle man and individual who has relationships with two sides with institutional equity groups and then sponsors like us. So would you kind of maybe explain a little bit more color and nuance as to exactly where you are in the marketplace, where you provide value to both sponsors as well as equity providers?
100%. You know, in a perfect world, or in a typical market, right? If you want to buy a deal, like let's say it's a $70 million deal, and you're $40 million of financing, it's, as Craig, you probably know, it's pretty hard to come up with $30 million of LP money from a check writer that's going to write 50 grand at a time, or to collect check writers of $50,000 amount of 30 million. It actually was being done in 2019, 2020, 2021 quite effectively, and we could probably get more on that later. But in a normal world, there's only one real place to go for equity like that. Either you could just be a warrior and find partners and find co-GPs who will raise the money with you and build this whole, team to come up with that $30 million to close. Or you can go to an institution. And for institutions, $30 million of equity is like the typical, I would say, very vanilla check size. I mean, there are institutions that their minimum check is 100 million, and there are institutions that their minimum check is 50 million. There are many, many, many that have their preferred check size is around that 30 million number. So it puts you squarely into that institutional bucket. The question is, let's say you're a sponsor with, I don't know, 2,000 units under management. So you've done a few deals, you've exited a couple, you have quite a track record already. And you would sell well to an institution, you know how to report to an institution, you underwrite carefully to their standards, and you have a good asset management team to be able to, again, track the progress of the asset and then report it consistently to a sophisticated group. So you're ready for that, but you just don't have any other relationships. So that's where we could create value for a sponsor, as we already have these relationships built. If you send us a deal and we think that the deal could be a fit for one or a few of the institutions, we would be happy to potentially engage with such a sponsor and then go to those institutions with the deal, as an introduction to both the sponsor and the specific deal. Easier said than done, of course. There's a lot of difference between the way institutions invest relative to how, or compared to how retail investors invest. Just to define terms, when I say retail investors, I'm talking about those smaller check writers who will write 50 to 100 to $500,000 into an investment, as a purely passive LP. That's in distinction to what the world that I'm in, which is the institutional equity world. So we build all these relationships. It's with institutional equity and family office equity. Again, we could also talk about that a little bit later. But those are our relationships. And then we maintain relationships with sponsors. We see what they're working on. And, sponsors could go and build their own relationships, and very often they do. And sometimes they come to us already knowing many of the groups that we speak to. But more often than not, they know only a couple of people or a couple of groups, and the rest of the world that's out there is unavailable to them unless you have an intermediary who has access and a relationship already built. So we bring the sponsors to the equity groups, and hopefully, if there's a meeting of mind on the quality of the deal and of the quality of the sponsorship, an investment could be made by the institutional equity group.
Absolutely. And I think that was well said and defined there. So let's just kind of talk about maybe the first part of that conversation, which is the sponsor level. So naturally, and by the way, Jonathan, if you're not following him on LinkedIn already, you need to. He always has very compelling write-ups and conversations, and his engagement is impeccable. So if you want to take a note out of how to navigate LinkedIn, he's literally LinkedIn 101. So give him an ad and a follow, and we'll find out ways to reach out to him later if you want to work with him or pick his brain or get into his ecosystem. But with that said, let's talk about sponsors. What do you need to feel comfortable? Because it's a two-way street, and your credibility in your situation is always at stake, right? So let's think about this. You want to make sure that you have sponsors who have probably gone full cycle on a deal, or at least someone that you feel is credible. Maybe they were part of the brain trust of another group, and then people from here kind of start their own entity, and you feel comfortable. So there's that unique situation. But typically speaking, what do you need from a sponsor to have them show you something that would make you feel like they're convincing and should be working with an institutional group? Because institutional equity is not for everyone. It is not a perfect fit any way you slice it. So I'd be very curious to know how you see the world of looking at sponsors as you see them all day long, what that process looks like, how you get comfortable to connect them with your valuable equity relationships, and can you please walk through those logistics and dynamics?
100%. There's no clear answer. I think if you just do it, a lot of learning is experiential, and a lot of learning is also not easily definable, right? So sometimes it's just like your gut tells you that this sponsor will just sell very well to institutions. But obviously there are rules of thumb. Like we don't work with sponsors that are doing their first deal, obviously. So we're not going to represent anyone that's doing their first deal. We're probably not going to represent someone doing their second deal either. It's typically somewhere like at a minimum seventh, eighth deal, maybe 10th, after a couple of exits at least, to show that they've gone full cycle. That's like, I would say, the bare minimum. And then also, look, we do more than just multifamily. I mean, we have experience in retail. We've done some industrial. And it also differs by asset class, which maybe I don't want to open up right now, but multifamily is an asset class in which sponsor strength is, I would say, maybe marginally more important than, let's say, shopping center acquisitions. There is a lot of ways that you can create value. Let me say it like this: it all starts. The first thing we look at is actually not even the sponsor; it's the deal. Okay, and there is a world in which the deal is so absolutely incredible that you're able to kind of get away with a less qualified sponsor, so long as there's someone that they could pass a background check, because most of the LPs will typically do a background check and so on. As long as it's not a crook, right? If the deal is absolutely incredible, then there are often ways to get a deal done even without a sponsor who's incredibly qualified, right? One example of such a deal would be like in the retail world. You see this a lot, where a sponsor will find a vacant retail location and will fully lease it while still under contract to like a 9 yield on cost when it's worth like a 6.5 cap in the open market, which means by the day they close the deal, they've already completed the entire business plan and have created all of the value, and there's practically no risk left in the deal, right? So if you're a guy who's doing your first deal and that's the deal that you've come up with and you've secured the lease and you want to close and you have 45 days to close, there is a world in which you'll find an investor or some kind of capital to close that deal, even if it's your first deal, right? Multifamily, you don't really have that. In multifamily, you have, it's a grind. You need to really know operations well. You need to have a well-oiled machine for property management and asset management. You need to, manage renovations and unit turns and so on. And the value creation doesn't necessarily happen overnight like it could in retail or in industrial. It's a lot more hands-on, so sponsor quality becomes much more important. So I would say, putting retail and very unique deals aside in which you could get away with a lesser sponsor, let's stick to multifamily, in which sponsorship is always important. And I would say at the very, very best that we look for is a sponsor that already has experience working with institutions, so they have all of that apparatus built out. And for one reason or another, their institutions that they've been working with are not investing anymore, or they're just looking to expand into new equity relationships. So you take a sponsor that has 15, 20, 30,000 units under management with plenty of private equity or institutional investor experience. And then those are going to be the sponsors that obviously for a group like ours would be incredibly valuable to have relationships with and develop trust with enough that they'll let us see their deal flow. You don't always get that, most of the groups, there's a little bit of a catch-22 in that, because those groups, they're so large, they very often don't need help raising equity. There's the reason they've gotten so large in the first place. And you're often stuck with groups that, are not stuck, but you often have to learn how to service groups that are smaller. So I would say that it's in terms of like the hard numbers, we typically look for a couple thousand units under management, a couple 2 to 3 exits at the very least, been in business for 5 years plus. You also have to know the people to know that they're capable of reporting. If you happen to know them, you know that they're a complete mess of an operation, and they're very used to just their mom and pop investors that aren't so demanding on the reporting side. Like there have been groups that I just said that we can't work with them because I knew that they just would never be able to handle, or they wouldn't be able to even grasp what the institution is looking for, because their operation wasn't built for it. So I would say that's kind of like what we tend to look for. But there are situations in which you bend the rules if the deal is very good, or if the group is new, but they were all like top executives at a very large firm, and they broke off to start a new firm. So these guys have a ton of experience already. Like it's not, it's a new firm in name only. It's not actually a new firm, and so on and so forth. So I don't know if I answered the question. I hope I
No, that does. That
some
it's
color, but that's
yeah,
all. That's
yeah,
all. Yeah, that gives you a little
that
bit of the gray area of vetting a sponsor.
Yeah, and with that said as well, it's interesting. You mentioned a couple points I want to unpack a bit more. The first point is with pertaining to multifamily real estate as opposed to retail and industrial, and we'll kind of get into the asset classes that you look for and how you handicap them. Those businesses are not as fluid in the sense that multifamily, it's kind of immediate gratification, it's immediate, mark to market because you've got 240 units, potentially 200 plus units where people are moving in and out all the time. So the market is going to quickly let you know if you're priced correctly or what the improvements can be done there. But if you get into retail or industrial, these are sometimes only a couple tenants in there, maybe just one tenant, where there could be a massive miss there. Where to your point, you sign it and they're locked in for 5 years with incremental improvements and spikes up in the lease. Where it's very clear that the path to creation there, it's not potentially as linear in multifamily, right? So there's a little bit more nuance there. So when it comes to on your end regarding finding sponsors, working with them from a pipeline perspective, how do you manage that? Because, of course, if someone's so long in the game, they've got their relationships, there's hard for you to kind of implement that much value. So you probably want maybe someone, or do you look for people that are kind of rising stars and shooting up in the space? And do you look for that, or are you looking for people that are kind of in that, 2,000 to 5,000 unit count, where you're kind of tracking both those kind of two people? Like where do you find your best clients, where you bring the equity to their opportunity should they kind of hit your snuff test?
The best clients are it's not, I mean, every operation, it's not a big enough sample size to know like what is the best way to do this business. Like thank God we've had a couple of very good years. And we've been able to close a decent number of deals, but like, it's a small company. There are 5 people in my company, and it's like, I can't tell you if what we do or what we found success in is representative. We found the most success with large groups that carry already a very good name, that had a temporary lapse in their equity, where we could create value by filling in a temporary lapse. So we're finding more success with groups that are already a blue chip name that for one reason or another needed to find a partner for whatever situation. That's where I'd say it's easiest to get deals done, because you have extraordinarily high quality sponsorship in which you could press very hard when you're talking to an institution. There is a need. And on the LP side, they kind of feel like, wow, like we've known of this group and we've seen them at the conferences, but they've always been, well capitalized and never needed our money. And all of a sudden, John Levy comes to us and says, by the way, there's an acute need for capital right now. So the LPs are more motivated to jump in that case. So in terms of like what has happened historically, those are the deals that are typically getting done. It's always a grind. It's always a grind in terms of like we're always networking with anyone and everyone. You never know where your next deal is going to come from. We have done some deals with much smaller groups, but the deals were just so compelling. We found a way to get them done. Um, in a perfect world, you find that rising star and they do one deal and they do 5 deals with the same equity group and you get paid on all of them. It would be a lot in commissions, and there's a reason for that because it's also extremely hard to get done. So I would say that kind of encapsulates where we found a lot of success. It doesn't mean we wouldn't want to work with the rising star types. And I envision as the company grows and our deals become more representative of how this business works, we'll have a lot of those and we'll do business with a lot of those. But yeah, that's a little bit of a summary on our company.
Without a doubt. And I think there's kind of a couple of ways to approach it if you're a sponsor thinking about, employing someone like yourself to kind of fetch the equity and kind of, leverage your resources and abilities is a couple of ways to think about it. There's some people who are maybe newer or honestly don't like going out and meeting a bunch of people. They don't want to go out and kind of do the dog and pony show of NMHC and, IMNs and things of that nature. And they kind of just want to have more of the resources in-house for asset and property management, but they may not have a formal salesperson like myself, like in Lone Star, or they just might be at the point where they don't have any of those relationships, but they know they're pretty good at what they do. They just haven't solved for that yet. So you come into place here and can really help them to get to scale quickly, especially if they're, they could be dynamite at acquisitions, but be really lacking sales. So you could kind of come here and ping them up and kind of get them to scale. Have you kind of seen that been the case for some people who just don't put as much
Yeah,
of an
yeah,
emphasis on
100%.
the raising?
You find it all the time. Like groups come to us and they say like, wait, how does it work? I mean, I thought these sponsors, if they're experienced, don't they already have money? And it's not as black and white as that. There are a lot of sponsors that they've done a lot of deals with one family office, and that family office doesn't really want to invest anymore because I don't know, they're looking to start doing capital preservation instead of capital growth, and now they're looking to only be lenders instead of investors in the equity side. So all of a sudden, you're left with a great sponsor that doesn't have any investor, and he also doesn't. It's not. He's an introvert. I don't know. The guy's an introvert. He doesn't want to go to conferences and shake people's hands. And for him, like he has a deal already that is under contract and is 90 days to close or 60 days to close or whatever it is. And he's not going to go in 60 days and build 23 relationships with 23 groups that the deal fits their criteria. So it does create a lot of value. Look, there's also value in another element, which is in the negotiation point in period. We see a lot of terms thrown around from LPs and whatnot, and we know what's market for an LP to charge or for an LP to expect versus what a sponsor is going to charge. Nowadays, very often it's much more managing expectations of the sponsor because sponsors have no idea how expensive institutional equity can really be, how high the prefs are, how limited the fees are on such deals. You can't charge whatever you want to the LP. They do not, they catch it and they do not let you charge it. Unlike, kind of with the retail money. So both in terms of those of situations where sponsors are like most of the time, even the sponsors that are super well networked, they still don't have as robust a network as a group like ours that is what we do professionally, right? So there's always some value, or almost always some value to create, even for the well networked sponsors. There are very many sponsors that just aren't well networked, and you're their ticket into this world. And then even beyond that, we create a lot of value in helping to smooth out the negotiations once a term sheet is issued and once we're really starting to try to build a partnership.
Yeah, I think you said a lot of interesting points there. So, theoretically, if you're an emerging sponsor who's looking to get into the institutional space, you may be sobered up very quickly to realize some of the fees associated because you can almost charge, to a co-GP or fund-to-fund manager, or not charge, but just the fees are just different there as opposed to what institutional equity groups get. So that's really something to think about if you do want to step into the institutional space. It's kind of the age-old question Rob and I ask ourselves, is it better to syndicate or do institutional money? And the answer is both. And you could probably make a little bit more money, but have to deal with a lot more headache if you just syndicate. But it is nice to know if you got to, call it, a group like Starwood, whose minimum check is like 50 million bucks, and you're doing $100 to $200 million acquisition on a portfolio, you can kind of hit that scale there and find that equity in one tranche. or you could kind of piece it together with other groups who maybe have a minimum mandate of $8 million. So there's kind of a wide a range where groups kind of can come into place to place equity there. But there's no right or wrong. But I think you also mentioned something that's super valuable there to work with you if they have no access to the world, which is actually finding what market par is for a sponsor and for an institutional term sheet, because these terms are not the same. You're not going to get the same asset management and property management fee. You're not going to get X, Y, or Z from what you're used to. So it might be a massive learning curve that you're going to go through the institutional space that you can kind of navigate them. Have you kind of found that a lot of people are, really wake up to it and kind of, really get probably a lot of value on the front end with kind of you telling them what, left and right and up and down is to kind of help them get their compass in the space?
Yeah, I mean it's more of a frustration than and then it's one of the biggest frustrations in the business is, when that rising star sponsor has to all of a sudden go from charging 2% AC fees with a 2% asset management fee on EGI and a 30 over a 7 with a 50 over a 15, and then has to go to a 1% AC fee with a 10 pref and a 15 over a 10 and then a 20 over a 15, with 1% asset management fee on EGI and 3% max property management fees, which is, I would say, very typical in the institutional
Yeah.
world right now. There was a lot of, I would say this, when a sponsor comes to us and I could tell that they have a well-built system for raising money from syndicated sources, I often tell them, if you can raise the money on your own, please don't bring me your deal, because if I were to bring you, and by the way, I'm in a best efforts business, so it's not like we bring a term sheet on every deal we take on. I mean, it doesn't
Yeah.
work like that. It's just not
Not
like that. It's just not. It's
not
just
every
not.
deal is going to get that, unfortunately, and the timing
Um,
might not make sense.
not every deal gets a term sheet. No, not at all. And part of being a good equity broker is kind of picking your battles, knowing which deals to take on, and being friendly but firm about or candid to sponsors that you don't think you'll be able to get a term sheet on, to just not start and not waste their time. But one of the things that we do from the day one is, if we know that the sponsor has a very good apparatus for raising money and they're going to raise it anyways from syndicated sources, just tell them, just do that. You're going to make so much more money. And we don't want the headache of having to sell you on the 11 pref 15 promote that the LP is going to want on this deal when you're already getting a 7 pref and taking a 30 after that. So that is, and by the way, there are times when deals die after term sheet on terms. It happens all the time where the deal, we prep the sponsor. In one case, we prepped a sponsor for a 10 pref and a 20 after a 10, and the terms came in at an 11 pref and a 15 after an 11, and it was like, the LP obviously was expensive, and it wasn't it was a deal that didn't have that many takers, but and ultimately the deal died because they were just not willing to stomach that expense. So you got the term sheet, the equity's waiting there, ready to close your deal, and the sponsor just doesn't want to feel like the sucker, so they don't take the terms.
Absolutely. So switching gears to the other end of the spectrum, which is of course the LP equity side, what are those conversations and situations like? Are you looking to find a managing director that you build a relationship with? Do you think it's harder to find quality sponsors or build relationships with LPs? Because it's not easy anyway to slice it, right?
It's not easy either way. Look, sponsors find a way to reach out to you. Everybody is always looking for equity, right? So you get a lot of sponsors reaching out to you. The question is, can you get the right sponsors to reach out to you? So that's very difficult, because you think like, okay, your job is easy. Like, everybody wants equity, so I'm assuming everybody reaches out to you. And then it's like, yeah, but if everybody is reaching out, how many people? Is there a way to feasibly do business with them? So on that side, it's difficult, because there's a lot of building relationships, waiting around, being kind, even though you know that there's no immediate deal that could be done, but then having a good follow-up game for when 3 years from now they're established and they're ready to potentially see their deal flow. And the LPs, it varies. I mean, there are some LPs that are extremely easy to break into, and those are the ones that they are extremely motivated to put out capital, and they're willing to talk to everyone, and they'll never ignore your email if you're a broker. so on. And then there are some that play very, very, very hard to get for whatever reason, snobbery or whatever. Um, and you just like you need an intro to get in or some foot in the door, and then like they don't want to be speaking to brokerages or something like that. So it's always hard. It's always hard. You get creative. You have to meet a lot of people in person. Like there's only so much the person could do to avoid you when you walk up to them at a conference unannounced and introduce yourself. Like you just, sometimes you just have to network hard and network aggressively and be a little bit outside your comfort zone. Um, it's hard on both sides. What can I say? You just have to network a lot and be strategic and have good systems in place for making sure that you're taking the right shots on the right deals and you're increasing the probability of having closings.
Without a doubt. And I think it's really interesting there with regards to networking. I'm sure you can appreciate this, but we, of course, last saw each other at MHC. I'd say we see each other about 2 to 3 times a year, depending upon what's going on.
Yeah.
If you're going to have a kid or not here and there. And I know, of course, you're a grown family man. So conferences and traveling may be less frequent, of course. But with that said, I have a conversation point that I think is interesting, which is there's sometimes we get the email back saying XYZ person is no longer at this firm. Please reach out to said person now if you have any inquiries, that. So sure enough, I would say about 50% of the time, if someone leaves, a managing director or someone who kind of handles the deal flow for, representative areas, if that person leaves and you email them back, what happens, typically speaking, unless you've done a deal with them, you could be building all this rapport with them. But if you've never done a deal with them, the people that you email there usually just very much so disregard you. And I found that we get, kind of pushed to the side, like, oh yeah, thanks. We'll let you know if we need you, which is kind of, hey, fly a kite, unfortunately. And, thanks, but no thanks.
Right.
But it seems like the only way to really meet these people for the most part is really two ways. It's a warm introduction, or if you're at a conference. I found that when I've gone to conferences like IMN, NMHC, and, the bigger ones like Ascent or Elevate, you get really great access into working with people, and then there's a frame of reference, because if not, you're just another person that just emailed them, right? So it does seem like there's just no substitute for in-person networking conferences. And Rob and I are always trying to go to conferences, but we found that to be the best strategies in person.
100%. You're right about that. Conferences are a great way to build this network. And again, because that's the best way to build the network, the sponsor who's already like trying to find deals and is running around everywhere to try to find deals may not be in a position to even have the time to go to 10 conferences a year to meet these people. So you're kind of doing the work for them. Another thing, by the way, is also getting a little bit lucky as to timing with the LPs. Because if an LP is at the beginning of a fund that they just closed and they've just started investing the funds, they'll be far more motivated to invest than an LP that is on the tail end and has 20 million left and they have 3 deals they're choosing between. So like try to add your 4th in, you're probably not going to be the one they choose. So more than even getting to know them is then having a relationship with them so that you kind of get the inside scoop. And then beyond that, like very often you'll find, your first call, they'll tell you this broad range of criteria. And then as you get to know them, they'll reach out to you and say, we're actually looking for something quite specific at the very moment, because we have a mandate from our owner that we want specifically Class A in this specific market. And once you have that more laser focused criteria, it gives you more of an ability to add value for the LPs. So it's not only about knowing them, it's also about having then a relationship with them, so you could get some of this insider information that can very often be the key to you getting a deal done. We had one deal, I think I did like 4 years ago, where the group told us we are specifically looking for cash flowing deals in the Midwest in a specific market. I won't go into the market. And so we kind of networked and started reaching out to all of our sponsors one by one. And on LinkedIn, we mentioned that we have an LP looking for something in this market. And lo and behold, one of the sponsors we worked with was in that market and had a deal under contract that was cash flowing, and it was exactly their criteria, and the deal worked out. So, that thing may happen here and
there. That's awesome. So what else outside of maybe what you mentioned earlier that our LPs looking for in the current marketplace? Is it always switching group per group? How do you think, they go through the process of seeking what they're looking for? And, Can you kind of talk about the other end of the spectrum and what you're looking for from LPs as well, on the other side of the coin?
So let's keep it to multifamily, just because I'd say there is right now in today's market for multifamily, there is a very continues to be a very large focus on quality of asset. Um, Class A multifamily new construction is, let's say, the prime target for almost every institutional equity investor right now. Everyone is out there trying to hunt very good quality assets in good growth markets that are business friendly and that don't have a pipeline of rent control legislation in the hub, right? Um, so we're honestly just when we look for deals, when we look for sponsors with deals, very often like the first thing we're going to vet for is the vintage of the asset. If it's a 60s or 70s deal, there are just so few groups that are willing to take it that we know the ones that would be, but it would have to be a phenomenal bargain for us to take it on. And then we're upfront with the sponsors, like this is not going to be a very long and arduous process. It's going to be 3 or 4 groups, and we'll let you know what they say. Now, if it's a newer vintage multi in, I don't know, Dallas, Charlotte, Atlanta, Miami, Tampa, Salt Lake City, Phoenix, and so on, newer vintage 2010 and newer, there's going to be a slew of investors that want that product, especially if you're in the right part of town and you're buying at a good basis. There's a very big focus on buying below replacement cost. So if you could prove that you're buying a relatively new asset below replacement cost, and your basis is good, and you have a decently high cap rate, which puts you into positive leverage territory going in, or at least with some positive trade outs that are proven, you can get to positive leverage within a short period of time. You have a deal that can be very interesting. Now, what I did not say is that we look for a high IRR. We do not look for a high IRR at all. We don't even look at the IRR practically. The IRR is like an afterthought. We're looking for fundamentals: basis, going in cap rate, vintage quality, and location. Age of asset, meaning vintage and location. If you have those things in the deal and you're under contract, and I'll say the another thing which is maybe a little bit new for this market is the story behind how the deal came to be. Like, we have most of our LPs tell us right out, if the sponsor bid on this property in an open bidding process, and there were other groups bidding and they just were the highest bidder, do not bring us the deal at all. I don't care if you think, John Levy, based on what you're saying, that this was the one case where CBRE decided to not run a great process, and this is deal is being bought at a low price. Don't bring us a deal. So if any of the bigger brokerages are marketing a deal, that unless there's a broken process and the buyer backs out and then they decide without marketing heavily again to go to another buyer at a significantly lower price, and you have a story, then you're probably not going to get LP interest. So to sum up, what we do look for today is a story, off market, forced seller, broken sales process, something like that. Newer vintage, growth market, high going in cap rate, below replacement cost. If you have those items in your transaction, then bring them to Levy Capital, and we will most likely take them on, even if you're not the most experienced sponsor in the history of the world.
I love that. So what returns are you solving for then? I mean, you obviously look at their underwriting, you're going to handicap it to make it more reasonable, because we all know assumptions and inputs can vary across the board. That's not a like for like perfect science. There is some artistry there, but that said, what return does it have to make sense, or do you kind of look for yield on cost, or is there other metrics that you look at?
Typically, so first of all, we don't typically touch the underwriting of the sponsor. We don't want to get involved in that. That's very sensitive. The sponsor's underwriting is a sponsor's underwriting. What we do is we screen. So if the sponsor is underwriting an 80s vintage deal to a 5.5 exit cap rate in this market, we'll probably ask them, could you re-underwrite to a 6.25 exit, because we don't want to put our name or try to push something that we think has an awfully high exit cap rate, awfully low exit cap rate, excuse me. So if we ever do tweaking to underwriting, we ask the sponsor to redo it and then send it to us redone, just because every model works differently, and if we use the wrong input field to toggle an input and we screw things up, we're going to be misrepresenting the sponsor's numbers, which we don't want to ever do. So that's one rule at our company, that's just the way we do things. In terms of what we look for that makes a deal compelling is more than the returns, is going to be the yield on cost. If you're buying a good deal in a good market and you're stabilizing to a high yield on cost, and you could justify the growth in NOI that gets you there, then the IRR will tend to figure itself out. So yield on cost is the number one most important underwriting projection that we consider, and it's a lot. There are a lot fewer variables that go into determining the yield on cost than, let's say, the IRR, the deal level IRR. So that's why it's a better gauge of what's actually happening at the property.
Without a doubt. And I think the more sophisticated people, that's the number one thing they look at really is, yield on cost. They want to see your exit cap rate. They really want to figure out how you can arrive to these conclusions. They want to see your expense ratio. So just a little inside baseball for those who are looking to crack in those spaces and kind of know what they're looking for. It's definitely those items as mentioned. There's certainly a lot of other factors that go into it, but those are kind of the biggest key metrics, as long as vintage, which you pointed out. So I think that's exactly what we've seen as well, which is so fun to have these conversations to kind of really cross-reference points. With that said, when it comes to story, though, I do find that interesting because, of course, that's probably, how, there's just a lot going on in the story right now. So it's kind of tough, though, a lot of these properties that are more institutional, if you're looking at institutional equity, where these deals are typically always going to a marketed process, right? So, you're really looking for a diamond in the rough there, because a lot of groups like us, if we have a mandate to hit market and to go to full market process, search high and low for a buyer. So, is there any truly unicorns that do kind of come across your desk where there's kind of a random bizarre situation why the deal isn't being shopped more publicly? Because logically speaking, you're going to cast the widest and best net. Is it maybe a privacy reason why that wouldn't occur? What really would solve that?
There are a lot of reasons, and it does and it's you'd think it doesn't happen, but it does. Look, there are a lot of times when there's a very strong buyer and the seller gives the broker a mandate. If you have a buyer off market and we could get this deal done quickly, and it's the price that I like, I'm not even so concerned about exploring the market to squeeze every last nickel out of it. Give me your 3 best buyers and let's do it off market. So that would call off market through a broker, which is extraordinarily common. So that's one situation in which the story is not that bad. You have a lot of broken processes in which a buyer is not able to perform, and the sales period was timed to kind of align with a debt maturity. And by the time the buyer is not able to perform, the seller is now in a bind because he has a maturity coming up and 45 days to find a new buyer, in which case he may have to take a massive haircut, even though the property was marketed. He'll have to take a haircut just to find a buyer who's able to perform. So you have situations like that, which are very natural and occur and happen all the time. I'll say that's very, very often how deals come about is broken processes more than anything, where a buyer couldn't perform and our buyer that came to us at a lower price is the next one on the list at a much lower price. There are some groups that do a lot of cold calling, and there's still some here and there owners out there that are mom and pop owners that have owned the property for 30 years and haven't raised rents, more than inflation, or even have kept it below inflation. So there are just tons of room on rents. That does exist sometimes, and we see that. Yeah, these things happen. I mean, look, obviously, if you're smart and you have time, you're going to want to get the highest price for your property. So you're going to market it, and the institutional LPs, they're already getting promoted up, right? They already are paying fees to a sponsor. So if anything, if they're going to do that, they're just going to buy it themselves. If they're going to go on market, they're just going to buy it themselves. They're sharp. They could run a property.
That makes sense.
So yeah. They only really need a sponsor. And by the way, there are a lot of LPs that do that, where they have, when the things that are on the market, they bid on them, and if they win it, they win it. It's better for them that way, because then they don't have to pay the sponsor along the way. So they'll overpay for the deals where they have lower cost of capital because they have no sponsor in the middle. And if the sponsor brings them a deal that he's underpaying for, then they'll consider working with the sponsor. So you have, situations like that.
Yeah, and well, it's funny because a lot of these deals sometimes too, one we're actually buying right now, which we can't speak about due to the structure of it and the nature of it, but we bought that deal. It was more marketed widely in, the summer, and then things happened and they need to sell, and we were the buyer of choice, fortunately. So stories like that do happen. It's just kind of rare when it does happen, and that deal did have a good story, but story really seems to be a big key. So initially, another question I have for you with regards to institutional groups feeling comfortable with the sponsor, how important is vertical integrations? I guess this is my first question. And, do some LPs actually not want a sponsor to be vertically integrated and they want to put their own kind of tentacles on, management? How does that typically play out in your opinion?
There are, so in general, it's a good thing. In general, vertical integration is a great thing. It's something that we would tout and we would show off. And the sponsors vertically integrated, they manage internally, they have their processes all aligned, and all interests are aligned. And there's no property manager that makes money off vacancy because they could release the property and so on. So in general, it's a good thing. Is it an absolute necessity? No, we've done deals in which we just did a deal in which it was a phenomenal deal. But the sponsor was using a third-party manager, and there is often a good reason why they choose to, because that third-party manager already manages for them in the market and is doing a phenomenal job. So they could lean on them and achieve scale by using the same one again for the fourth property they own in the market, and so on and so forth. So you have that. Again, it's good. It's an absolute necessity, and to the extent that an LP would want to potentially put their own management in place, you won't see it much with LPs, but you'll have some co-GP groups that will say like, okay, we're happy to partner up with the sponsor, but if we do, we want our management team to be managing day-to-day operations at the property on a property management level, not necessarily an asset management level, but on a property management level. So you'll see that with some co-GPs. I haven't seen it much with the pure LP shops. I don't think they have it's not like property management is a massive profit center. It's not like your property management. It's a very marginal business. You typically have to achieve a lot of scale to start making money. So I know a lot of vertically integrated shops that take a loss on their property management side just because it looks good and it allows them to raise money more effectively. So yeah, so that's my experience on property management and third party and so on.
Yeah, no, I appreciate the insight there. And I think a lot of people, that's good to know, because if you're not vertically integrated and you're a sponsor listening to this shouldn't discourage you from, employing someone like yourself out there, or, have a limiting belief that they only work with vertically integrated people. But it's just another factor and layer there that is a conversation. I think, the rule of thumb is, generally speaking, if you can have vertical integrations, you likely should do it, but it's not by any means an extra stream of income that's really going to make you rich. It really just keeps things afloat and keeps quality control top of mind.
Correct.
Yeah.
That's a good assessment.
Without a doubt, I think that's super crucial to think about. And then another kind of question I had for you is, we hear often that a lot of institutions are on the sidelines right now. That's kind of been the ringing terms, pencils down unless you have a unicorn. Well, who doesn't want a unicorn? But as we both know, I haven't seen many unicorns in my day, nor have you, although you see deal flow all the time. So, what's kind of the state of equity, would you say? Because I'm pretty optimistic about everything currently, as we've had. I think being at NMHC was a breath of fresh air. But, it seems like people are looking at deals more seriously and are starting to deploy equity. But from your perspective, what's kind of the beat on that currently?
So it's always going to be hard, right? If you're going to earn a massive commission on something, it's never going to be easy. So yeah, right now LPs are looking for a unicorn. So your job is to look for a unicorn. You know what our problem was in 2020? Every sponsor that was good at raising money was raising money from the abundant retail investors that were out there. So any good deal that actually existed was getting gobbled up by people writing checks of 100,000, and then the institutions with their 1% maximum AC fee and 20% promote after an 8 at the time. Now it's after a 10. There was just no reason to take their money, right? So as an equity broker, you kind of like it just got very difficult to transact. So is it any harder to transact today, maybe, but marginally so. It's always going to be hard. I don't think there's ever going to be a market in which our job becomes easy and it's not a grind. Um, but yeah, LPs are very conservative right now. But on the flip side, sponsors need our help more than ever. So more sponsors are coming to us with deals. So if there is that unicorn, we could potentially find it more easily, right? So it's always hard. I don't expect it to ever become easy. If it ever were to become easy, it would be a blessing, but it's not to be expected. You can't build a business off of that. Um, I personally do think that something's got to give because there are LPs are being extraordinarily picky, and it's like, if every LP is looking for a unicorn and there's 4,000 LPs or like 300 LPs out there that are well known in the market, besides for all the other big ones that are chasing American real estate, um, something's got to give. Like they can't all get a unicorn. Not everybody's going to get a unicorn, and they can't all give money back to their investors that invested in their fund. So either their expectations are going to change, or deals are going to start to get better because this massive wall of maturities that everybody's been talking about is going to start causing people to become forced sellers. But I'll tell you from the conversations we've had, it seems like the institutions who've raised funds in this past couple of years have not had adequate opportunity to deploy in general. It's not like they're like, yeah, we're finding deals right enough to deploy into. We're having a very easy time deploying all of our funds. It's not the case. They're having a hard time deploying their funds, especially the ones that raise preferred equity funds. Preferred equity deals are extremely hard to make pencil. It's maybe something I've told you about. I'm not a big believer in the preferred equity fund craze that was happening. But yeah, it seems like there's a lot of groups, large groups that are underdeployed, that are looking for unicorns today, and either unicorns are going to start to appear everywhere, or some people are going to be left unhappy with their opportunities, their investment opportunities,
Yeah.
or their opportunity to invest capital.
Yeah, at some point you have to deploy money because you don't get paid to hold it and look at it and to count it and high earnings yield account, right? That's just
Mm-hmm.
you eventually they need to see the returns and something's got to give. And to that point, we've actually had about three groups call us on our most recent deal and just other deals generally saying, "Hey, can we invest in this deal?" This institutional people, which is very flattering, and they're struggling to find deals that make sense. So they're starting to definitely I think become less selective and picky as they're seeing kind of signs that now is a good time to invest and no one's going to time the market perfectly, but there's probably enough bleeding for them to feel comfortable to get behind, placing equity checks at this moment, which I do think is interesting. With that said,
Mm-hmm.
what is going on in reference to, I guess fund, or I guess let me rephrase this. With regards to rolling funds, how does that process look? Because if someone has got a $500 million to $1 billion discretionary fund and they got to deploy it, do you ever catch people in the right time where they just legitimately don't have an opportunity for their money and they kind of call you saying, "Hey, what's the best deal? Just find me the best opportunity and we'll put money into it within reason." Does that occur ever?
No, I maybe if I was maybe 10 years from now, this trusted advisor to funds, they come to me and say, just John, give us the best deal in your system right now, we'll do it. It doesn't happen like that. They're very disciplined. Even if they have money, they don't, unless there is a mandate for them to, open up to open up their criteria slightly, they're not going to. Um, I think for the most part, the incentive structures are built so that they aren't necessarily overeager to deploy capital in a bad way, or in a desperate way. Um, I think a lot of people that are screening deals, not to again, I don't mean this in a negative way. A lot of people that are screening deals are pure salaried employees, probably. So for them, actually turning down deals is a lot safer way to keep their job than to over be over eager to invest in a bad deal and then lose money for the fund. So I don't see that. If you have a very, very deep relationship, like it has happened. I mean, we've had a family office approach us and tell us, well, we have, a liquidity event and we're looking to invest with good operators who are the best operators in your system. So we'll line up a few intros for them. And, that has turned into a deal or two for us. But it's not like, the guy is managing the fund is going to call me and say, well, we need to deploy, just give me the best deal in your system right now. Like, doesn't, I wish it was that easy.
Right, right. With that said, kind of wrapping up here, with the recession looming, with maturities coming up, as we've alluded to, where do you think the opportunities lie? And I would love to have a more broad brush perspective on this, not just multifamily, but where do you think the opportunities lie in today's space right now for, value and outsized returns from kind of your perspective? Because you get to see every asset class.
The truth is, I don't know. I'm not a. If I knew, I would. Like, I don't think anybody knows, frankly. I think the market has a way of being efficient. Even even real estate over the years, I think with the technology and the ability for firms to see so much deal flow through a computer and the efficiency through which the brokers are able to get these deals out to, a representative sample of the market, even real estate has become very efficient, right? Um, so I don't know where the opportunities are. I mean, there are people that are taking a very, very contrarian approach and are buying very distressed office at 50 to 100 bucks a foot, where rents at the properties are 20 to 40 bucks triple net. And, they're buying it at a going in 10 cap with 50% occupancy. And they're betting that if they just lower rents enough, they'll be able to fill. And there are some people that saying those offices are dead and will have to be demolished or converted or something. Um, I like, I'm not, I'm a service provider at the end of the day. If I was a fund manager, I would build a whole thesis and try to sell people on my thesis and why I'm smarter than everybody else about how to make money in the market. That's not what I do. Um, I I look personally. I think inflation scares me a lot. I think the federal debt is like it's a great way to tax people without telling them you're taxing them, to just spend money and create massive federal debts that are going to cause the currency to be eroded. I'm scared of the value of the dollar. I guess it's like every other country also has massive debt, so maybe we're saved by just being able to be compared to every other currency in the world, which also isn't so strong. Um, but I'm a fan of hard assets, I guess is what that leads me to, and where to find opportunity. I mean, I guess all assets, if you buy at the right, any asset class, you buy at the right price, um, downside protection with conservative debt, and to not get ahead of yourself in terms of what you can expect in terms of returns. Um, you could do well. I mean, there are people in retail that swear by retail that we work with, and have made tons of money in retail, and there are people in multifamily that say the same about multifamily. And all asset classes, I think, are ways to make money in. I'm a big fan of fixed rate debt, and I'm a big fan of cash flow. I think with liquidity, cash flow gives you liquidity, and liquidity gives you the ability to solve problems. So my thesis is find opportunities that you could generate a lot of cash flow with low fixed rate debt, low leverage fixed rate debt, and you could probably find yourself a nice long career as an investor in real estate.
Absolutely. Well, I really appreciate you coming on today. We're going to have probably at least an annual, equity, LP play, and institutional conversation with someone like yourself. So you'll probably be a recurring guest and have to call in from time to time, which I hope you don't mind. With that said, Jonathan,
Happy to do
where
it.
where can people find you, get in touch with you if they're, an LP looking to deploy money, if they're a sponsor looking to kind of create these relationships, or if they just want to pick your brain to figure out what the best place to place equity is as you're kind of all over, and you got your hands in so many awesome cookie jars.
Sure. I mean, you could go on my LinkedIn. I think you could find my email on my LinkedIn. You can go on our website, Levy Capital. You can get my email from there. I don't have LinkedIn on my phone, believe it or not. I don't believe in having social media on a device that could fit in your pocket. So I don't have any social media, and the only social media I do have, which is LinkedIn, is not on my phone. So if I don't respond immediately, obviously there's nothing to be offended about. It's probably I'm just not on my computer or I didn't go on my LinkedIn for that couple of days or whatever. You could find my email. I'm much more responsive by, and all my information is there.
Awesome. And, if someone I think reaches out to me before I'll gatekeep on your behalf, but everyone knows my email. Once more, it's Craig at LSCRE.com. If you're trying to get in touch with them, I'll gatekeep the process. But if you seem like to be a good fit, we'll, of course, send you over to the founder and principal of Levy Capital. Thank you so much for being on the show. We look forward to seeing you again sometime in the not too distant future. And for listeners, thank you so much for being here today. Peace.